Strategy is not a crutch. Okay, strategy is definitely not a crutch. It's a tool that obviously a good trader can actually use to make some profits. The better the strategy is, the faster or the greater the performance, and obviously the larger the profits can be generated. However, if the trader himself is a very poor trader, okay, you can't rely on a good strategy for you to actually make money. Right? So it doesn't work like that. You need to be a good trader with a good strategy in order for you to actually make good money. Right. So I'd like to repeat that just briefly. Trading strategy is not a crutch, it's just a tool. Okay. It's required for you to make money, but just alone you can't really make good money because you need to develop yourself as a trader. Okay, so as I said, today we're just going to be going through the strategies. We went through one, which is a semi-automated one last night. Okay, hopefully you guys learned something from there. We'll go through it again towards the end. Hopefully, if we find time. Today's session is going to be a bit shorter than last night's session, and I will be providing the rest of the information that you're going to be needing afterwards. Okay, so first strategy, strategy one, is there are a few tools that you actually need to understand first. Okay, and I'm quite sure most of you guys are aware with these, and once you have a distinct understanding of what they are and why they're important, it will be much better for you, or much easier for you to implement the strategy itself, because you're going to know why it is so effective. Okay. Now, in order for any strategy to work consistently in the long term, it has to have an edge, right? An edge is simply the probability of your strategy working out over other strategies out there. Okay, or methodologies, whatever the case may be, right? So it has to have something that every single or most strategies out there don't have, and that's basically what a trading edge is. Okay, so if you were to describe it in, let's say, basketball, for example, okay, so a person's edge in basketball might be that he's extremely tall. So if you get a 7 feet, 7'5", 7 feet tall guy, and yeah, everyone else is 6'3", 6'8", he basically has a bit of an edge in that he is a bit taller than everyone else. Okay, so he can block um, shots and stuff like that. I'm not familiar with basketball, but I think that's how it works. So that is basically what a trading edge is. So if you have a strategy with a distinct trading edge, then you'll be able to make money consistently. However, if your trading strategy doesn't have a distinct trading edge, you will lose money. And if you're using money management, you're risking small amounts of money each and every time you actually take a trade, then you will lose money slowly. The only thing that strict money management will do for you if you have a very weak strategy is you will lose real money very slowly. And if you don't use money management, you'll lose it very fast. Okay. So a lot of people get that confused look on their faces when I start to say, okay, if you have a poor strategy, rather risk it all in one go or 2 or 3 goes. Because the longer you trade with a poor strategy, the more likely you are to actually lose money. Okay, so the 4 elements of this particular trading strategy are the round number, candlesticks, exponential, moving average, as well as the Fibonacci retracement tool. Okay, so these 4 elements, I will let you know why we've actually included in them and the importance of them. Okay. Firstly, we're going to go to round numbers. Okay, round numbers are a sequence of numbers usually used in institutional community to take profits, entry, as well as stop loss levels. Okay, now if I like to use the USD as an example because it's, I don't know, everyone can relate to it much better. If you looking at 13 Rand, US dollar versus South African Rand, right now, let's say it's at 13 Rand, that is a big figure, it's a round number. If it moves up to 13 Rand 50, that is a round number. So those round numbers attract a lot of investors around those areas. So if you're looking at 13 Rand, if people see, or the right people, if they see the market is at 13 Rand, they always feel like the Rand is undervalued and therefore will start going long at that particular area, right? So that provides liquidity. And if the South African rand is 16 rand 50 to the US dollar, then they feel like it is overvalued, okay? And therefore will start anticipating a decline, right? So those particular levels actually give us a really good idea of where the institutions are buying and selling. So we're talking about, because there's 3 tiers to trading, right? So there is commercial interest and institutional interest, and then there is the normal retail traders right at the bottom, okay? So we're talking about where the institutions are looking to buy. Your mutual funds, your hedge funds, all your professional traders will be using those particular levels to start for entries, exits, and trading and all of that stuff. Okay. Now, candlesticks or candlestick formations rather are amongst the most common form of analysis, right? Especially within the retail trading community and probably within the professional side as well. Okay, so I've known a few guys when it comes to the professional side of trading. Okay, I've reached out to plenty of them. Okay, I can say 2 years back or so, and a few of them have actually reached back, and I am working currently as well with some of them. So a lot of them do use candlestick formations, and you're basically looking for particular patterns that the candlesticks will form. Right now, there are, for me, 2 of interest, right? So the pin bar as well as the doji candle. I do have examples of that later on of how they look, but those are the 2 ones that are of interest. Okay. Now we're talking moving average, right? So pretty sure everyone who has ever traded before has an understanding of what a moving average is, and it's basically used to average out price movement from a certain price period back. Let's say, for example, the last 20 hours or 24 hours. The moving average will take the price for the past 20 1-hour candles, in this example, and then plot a line showing the average price over that period of time. Okay. So it basically smooths out price from the candlesticks, where because the candle might open 100 pips higher and then drop another 200 pips within the same minute. So it's choppy. What it does, it just gives you a nice smooth out line, and it's great for you to actually help determine where the trend is going. Right. I'll show you guys later on the advantages of that. Okay, now the Fibonacci retracement tool is basically used to measure the pullbacks in the market after a market has actually moved in one direction. So if, for example, the US dollar and South African rand rises 100 pips, okay, and then drops 50 pips, that basically means it rose 100 pips and retraced 50 pips. Okay, so it retraced a percentage, which is 50%, right? Because it's half. And the retracement is anyone's guess. However, after an extension move up, the big players will start to take profits and the smaller players will be left holding the bag. And so the pullback is a very critical part, because at the end of the day, even institutional players, or rather commercial interests, are looking to buy at the cheapest, right? So if the rand is at 13 rand and rises to 13 rand 50, okay, and then they're still looking to buy, they're looking to average in long, what would happen is the market will usually pull back from that particular selling from the big boys, and it will drop, let's say, to 13 rand 30 cents. Okay. And then they'll start buying up some more, because if you're looking at the amount of contracts that they're looking to buy, the price that they get into the market tends to be very important. So the cheaper they can actually get it, the better. Okay, so that's why we have these retracements, because now they need to get a cheaper or a better price than they're actually getting right now, and they need some liquidity from players who believe that the market is falling as opposed to retracing only. Okay, so a lot of traders will get that confused, retracement and as well as the market reversing, and therefore it provides a lot of liquidity that is needed to execute those big trades. Okay. So I just placed figure 1, right? That is a round number. This is an example of how it looks in the chart. So figure 1, we have a price chart with the candlesticks removed. Now this is only the prices going down on the right hand side, if you guys can take a closer look here. Okay. Right. So this is, I think it's 118, 117.50, 116.50. Okay, let me just zoom in. Okay, yeah, I think this is much better. Right, so this is 17 even, right? So this is 116.50. This is 116 even, 115.50, and 115 even. Okay, so we're just talking these solid black lines. Those are the big figures. Those are the round numbers that we're actually looking for. Okay. Now, these are what we call the round numbers, and the significant ones in this example are 18, 17.50. I think I went through them all. They are basically 50 pip increments, so they are 50 pips away from each other. Now, because these levels form a major part of institutional trading, we can therefore safely assume that there's a lot of liquidity around these particular areas. Okay. Now, there are great places to actually trade because there are buy and sell stops around those areas, and price will usually react around those levels. And day trading for small amount of pips is usually very fruitful around those. So any sort of like scalping methodology that you could employ would basically have, let's say if you implement a round number trading rule, right? To say, okay, I'll only short around run numbers, or I'll only buy around these big figures. That will most likely increase either the percentage of your wins or the breadth or the amount of money that you actually make per trade, because you're going to be getting those nice movements. Okay. Now this is just an example typical example of how a market would react around these levels. So you have the 1750 market swings down, okay, to trigger these sell stops at 1700, right? So sell stops just below 1700, because you must remember, if you're looking at how the professional side or institutional side trades, they will have sell stops, they will have buy stops. Okay, they will have buy stops or sell stops just below this level here, because that is what's considered a breakout, right? So that's considered a breakout. So the sell stop will be here, and what would happen is the market will probably break lower to activate the sell stop and then pull through, giving us that retracement we so greatly desire, and move on to the next level, right? Activating again the sell stop at 1650, right? And then pulling back to 1700. Some traders will place their stop losses at 1700, okay, as a big figure, and then we'll look at the market to make that swing low just below that big figure again, right? So this could continue indefinitely. Okay, I think there's a question, right? Guys, I think what you can do, just type in your question. If you can type, then just type a question. If not, I can just unmute you and then you can just ask your question for a moment. But I'd rather everyone type, because now there's a lot of background noise here and there. So, okay. Yeah, so you got a question there? I'm not sure. I can't hear anything. Yes? Okay, just type the question because I can't hear you at all. Okay, guys, so as I was saying, that is how typically we prefer the market to actually move. Okay, doesn't always 100% of the time go that way, but typically we only want to be in the market. Okay, I think I already answered that in the beginning, why we want to be trading around those big figures. It's mainly because of institutional sponsorship. Okay, those are the levels where um, your major company or your major firms and major big players within the market will actually be looking to come in and out of the market, because those are the more liquid areas in the market. Okay, because they attract investors. Because as I was saying earlier, you're looking at the USD ZAR, it's at 12 Rand, right? That will attract people into saying the USD ZAR is cheap. Okay. When I say people, I'm just generally saying traders, professional and non-professional as well, to actually come in and buy the USD ZAR around that 12 Rand figure, because it's deemed as undervalued. Okay, so it's a psychological level, psychological support. Okay, right. So figure two, what we just went through, shows how the price will typically move in a perfect world, as I said, around those big figures. Right? So as I said before, you only want to be trading when the market is moving the way that you want it to move. Okay, if the market starts doing stuff that you don't like or you don't understand, I mean, that's one of the benefits that you actually have as a trader, is that you can choose to participate in a market, or you can choose to sit out. Okay? I know a lot of people have this unending urge to actually be in the market, but if you can learn to separate a need to be in the market and trading opportunities, real trading, relevant opportunities, then you'll be able to become consistent. Okay? Now, this figure three shows what we've been talking about, but with actual candlesticks. So I took an example, and so the price has this movement about it when it actually gets to those levels, which you see those placing orders, pending orders rather, we're going to be using around those big figures. Right? So that's where we want to actually get in on the action, because number one, even if you were trading large, you'd have a bit of liquidity around those areas. And number two, that's the most likeliest place for the market to reject price. Okay. So I think just so you can see, you had a bit of a swing low. Okay, boom, to around 1750, and the market came down to 1700. Okay, as I mentioned, we'll tap and activate those pending orders on the upside. Okay, and then we'll reject. And same thing happened again, activate those pending orders on the downside before the market came up, boom, 1750, and then finally broke that level. And same thing happens, boom, the market will activate that 1650, reject it a bit, and then pull away from it. All right, and we had the market drop again. Okay, so this is typically what you'd like to see. Obviously, this is not information enough for you to actually take a trade just by itself. So you won't be just looking at the big figure without analyzing what the market is doing overall. Okay, so you're looking at what the market is doing overall, and if that, along with the other tools that you're going to be using, actually lines up, then only do you see that as a trading opportunity. Right, so actually looking to place your sell stops, where in this example, I think it's at 170, right? So major players, traders will be looking at placing a sell stop right over there, and therefore place their stop losses probably just outside the 1750 level or just before 1750, and the market will probably pull back, which then signifies, because you see the market stayed away from that level ever since. Okay, even the drop away from it was a bit aggressive. It shows that institutional sponsorship. It shows that there was a large sell-off at that particular area from, no one knows exactly who is from, but you can see by the black candles, the successive black candles, that it was an aggressive move to the downside. Okay, so the sell-off came in as a result of the price hitting that level, because remember, if you have a sell stop here and your buy stop or your stop loss is here, that basically means at 1750 you want to buy back the position that you sold here. So you sell and the market moves away, boom, 1750, then you actually become a buyer. You buy that, and guess who you're buying from? You're buying from whoever is selling it, right? Smart money. Then they sell, market is driven down, and same thing happens over and over again. So you're looking for those 1 or 2 opportune times for you to get your trades in as well, if everything that we're going to be discussing actually lines up. Okay, so safest place, as I said, to place a stop loss would be outside the round number range, right? So you're not looking to place it exactly at the 1750 or the 17 even. For in this example, your place your sell pending order would be somewhere around here at 17 even, and your stop loss rather would go outside the range, probably about 15-20 pips above your 1750 level. Okay, it's basically going to depend on how long of view that you actually have. So if you're looking at longer term view, you might place it a bit higher, probably 30 or 40 pips. But if you're looking at a short term scalp, you'll probably place it just outside the range, about 20 or 10 pips away from you. Okay, now Japanese candlesticks actually play a major role of technical analysis, right? This goes across the scope for professionals, for retail, and as well as commercial interests, right? Although they might not be using it in a conventional sense, it is relevant for them to actually know how these candlesticks actually affect price and what people are looking at. So we're going to be looking for a candlestick behavior when the market has already given us a signal and we've taken that signal, right? So it's sort of like as confirmation. Okay. All right. I mean, those levels we're going to get to, because we haven't really discussed everything that is within the strategy or the methodology itself. So this is just one part of it. Okay, as I said, there's 4 elements to it, so you need to understand all 4 elements for you to be able to make an assessment to say, right, I am confidently going to place the trade boom at 117. Okay, so for you to identify those levels, you need to have all 4 elements that I'll be discussing, right? And candlesticks will basically form just part of the confirmation. Okay, now as I said, they don't form part of the analysis itself, they form part of the confirmation. So let's say figure 5 shows us how the market reacted at the red arrow. Now if a pinning order was activated and those candles as a pin bar is usually a good sign that you are actually in the right direction. Okay, I'm not quite sure, let's just zoom in a bit there and see what level this was. I think this was 91 even. Okay, so the market just reached 91 even, boom, got a bit of a pin bar, and the market reversed. Right. So the second part then, moving average. Pretty sure everyone is very familiar with what moving average are, so I won't be explaining what they do and how they work and all of that stuff. We'll just basically go into the details about how we then actually use these moving averages to assess when it is an opportune time for us to actually trade. Right, so if you look at figure 6, we have a market trending to the upside. Okay, now generally what you'd like to see is a market that is trending. In order for you to be able to trade successfully long term, especially if you want to get those big moves, you have to look at trending markets as opposed to markets that are moving sideways. They're not doing anything. You won't be making a lot of money in those markets. You want to be in the moves that 100 pip move, let's say in a day, right? 200 pips in a day, 300 pips in 2 or 3 days. Those are the types of move that will generate you good money. Because here's the thing, you will then have a proper risk reward ratio that you can then apply with your strategy, which will then amplify, see what I did there? That will basically amplify your profits or your potential profits as opposed to you having to win each and every single trade for you to even stay afloat. So a lot of people make the mistake of trying or thinking that you're gonna win 98% of your trades and you're gonna be okay, right? Even a person who wins 98% of your trades can lose money consistently if they don't apply a decent amount of risk reward. I mean, it doesn't have to be 1 to 10 or 1 to 50 or 1 to 5 with, okay, but it does have to be reasonable, probably 1 to 2 risk reward. Then with a good win ratio, balance that out with a good win ratio, then you're definitely going to be making money. Okay, so now the moving averages are something that have been used conventionally for a while and very common. So if you're looking at these points over here, we have a breakout, okay, false breakout in this instance. So it's generally what we see in support and resistance, okay. We have a support, the market comes below support, closes, right, and then pulls away from that low, right? Same thing, closes below, pulls away. That's generally because around those areas, like I said, it's liquidity, because that's all trading is. You're looking at where everyone else is buying and where everyone else is selling. So you can just get yourself in the mind state of thinking like, all right, so that's where the big players are coming in. It's sort of like having an order flow book. So you have big boys coming in here, you have the dumb money here, and you have your institutional players coming in at those levels. So this is used a very common tool, moving averages, as breakouts. Okay, so they have algorithms that actually trade this. So if that algorithm sees a market close below the 200 EMA, it basically sells, right? Doesn't ask questions, it sells, sets a stop loss of, let's say, 50 pips and a take profit of 300 pips. Okay, well, that's generally how an institution would actually trade. They have much larger take profits and much smaller stop losses. And that means they can get 30% or 40% trades right and still make money in the long run, as opposed to the conventional way of the retail trader thinking, which wants a trader to win 90% of the time and still make money, not too worried about the risk reward, which is obviously the wrong way to think about things. So now basically what we want to do is when the market gives us this type of signal, sort of like type of false breakout to the downside, then we want to be a buyer. Because number one, if the market is above the actual price itself, that means we're in a uptrend, whether it's a long-term uptrend or it's a mid-term uptrend, but we are generally in an uptrend. Okay. And if the market is just in, let's say the moving averages are just within the market itself, then you know that you are in a sideways consolidation. Okay. If both moving averages, the 200 as well as the 50 EMA, are within the market, then you know that you are in a sideways consolidation. But if the moving averages are firmly below, then you know you're in an uptrend. You don't even need to do 5 hours worth of analysis. Like I said, I probably do less than 10 minutes worth of analysis a day, and the rest is basically dedicated to research. Okay. Now, strategy one rules. You want to buy in an uptrend and sell it in downtrend. Okay. That makes sense, pretty sure to everyone. And use round numbers for entries as well as exits. Now, price should bounce off one of the EMAs, whether it's a 200, on one of the 3 time frames actually chosen. So depending on what type of trader that you want to be, you're going to choose one particular time frame that's going to be the one for your executions. Now, the Fibonacci retracement percentage should be around between 50 to 62%. Okay, I'm not sure if we've covered that, but we'll get to it though. Now, you place your buy limits and sell limits about 5 pips before the round number. And the reason for that is sometimes the market doesn't touch those particular levels because there is some volume trapped around those areas. So the market will probably about 5, 7, let's say 3 pips closest to that particular price level, and then it'll just start shooting away. right? They'll just move away, because now if it goes back there, there are way too many people or way too many orders aggregated there that will, well, from traders that will actually start making money. So what you generally want to do, if you have a sell limit, you'd have to place it 5 pips below, and if you have a buy limit, you'll have to place it 5 pips above that price level entry. Okay, ideal stop, as I said, is about 50 pips. With practice, you can reduce that to about 20 so pips. Now, with 75 pips at least worth of profit potential. So that simply means if you're going to risk 50 pips, the minimum that you can actually get from the market has to be at least 100 pips. Now, if you have a 20 pip stop loss, then you can go for 75 pips in terms of profits. And the reason why we do that is because you don't have to rewrite most of the time in the beginning, but you can still make money. And as time goes by and you improve on your accuracy, then you'll be able to sort of like amplify your profits, but you'll still be making money in the interim as well. So as I mentioned, rule number 7, which I think is much more important than most of the rules, well, all the rules, risk an amount that you are comfortable enough, let's say between 1 to 3% per trade. For any trade idea, you are not allowed to risk more than 3%, simply because if you start risking excessively, you're going to get yourself into the habit, especially if you make money. Let's say you risk 20% of your account, right? And you make money with that one. You actually double your account within a day or 2 days, or whatever the case may be. You get into the habit of doing that, right? So the more, the first time you break, let's say, a rule, it's difficult, right? The second, third time, fourth time, it becomes easier. By the 10th time, you don't even notice that you're actually breaking a rule. It feels like nothing to you. So you just want to get yourself in the right trading habits from the beginning. To risk 1 to 3%. Obviously, once you're much more consistent, then you can start playing around with risk percentages. But if you're starting out, you generally want to be at 1% risk maximum on any trade idea. Okay, now, figure 7. This is just an example of what we'd like to see. Okay. You got that EMA bounce, which is on the 200 exponential moving average. Okay, I'll do that in the second half of the session. Okay, I'll show you how to calculate 1% of your account and what actual lot size that should be. Don't worry about it. And I do believe I have an Excel spreadsheet that you can just use. Okay. If let's say you have a $100 account, but definitely you're going to be using 0.01 in a $100 account. And the PDF itself is going to give you the lot size that you're going to be using. You just input your stop loss and you input your risk percentage, and it's going to give you the answer there. Right. So, as I was saying, in this example, I think to realize my eyes were this bad. I think this is 128. This must be the GBP USD. Yes, it is. And you have your big figure 128, and you also have a Fibonacci retracement. Okay. So, as I was saying before, with the retracement is basically considered by some as a reversal. Okay, so if the market has been in a decline and all of a sudden it starts breaking highs, then a lot of people, right, as I said, institutional as well as retail traders will be looking at this as a trend reversal and obviously looking to average in on the upside. And those who were short at this level, okay, not sure what this level is. I think this is 28.50. Okay, a lot of traders who were short at this level, okay, will place their stop losses about 50 or 60 pips away. Okay, so what would basically happen, the market will pull back, get those stop losses, right? So that would change whatever position that you actually had, because someone else is going to be assuming the short that you had here when you get out here. So they assume you're short at a better price than you, and then the market starts falling off from there. Okay, so the Fibonacci retracement tool, for those guys advanced probably know how to actually place that on your chart. So you just throw it on from your swing high through to your swing low. It's always going to be in line with your major trend. And you can see here the market pulled back, and we had all the things that we actually look for when it comes to a trade idea, right? So you have your 200 EMA, right? You have the market bouncing off from there. You have that big figure, the round number, okay? You have your Fibonacci. The retracement was between 50 and 62%, okay? And it's in line with the trend, right? So, yeah, it seems like we have a minute, guys. We can just take a quick 2-3 minutes break, and then we will commence. I'll send through the second code in the group in a moment, okay? See you guys now.